What's going on, guys? Welcome into the show. Today, I am joined by Morgan Keim. He's the founder of Ocean Ridge Capital. And before he made a name for himself in real estate, which you're going to hear all about his journey, Morgan was deep in the venture capital and startup world. He raised hundreds of millions of dollars in the food and tech space. But what's fascinating is how he used his W-2 income and his job, his active income, to start investing and building wealth in real estate, specifically in affordable multifamily housing. From his very first small deal, which you're going to hear about, to some of the large multifamily deals that he is now doing today. It's always fun to see where people start and where they're at and what's possible when you get a plan and you execute and work the plan. And he eventually walked away from the hamster wheel, obviously, to help others do the same. So in this episode, we dove into and talked about, of course, his journey from venture capital into real estate and how he was able to make that happen. The 3 types of leverage that unlock true financial freedom. I loved his perspective and outlook on that. Why affordable housing is one of the most overlooked yet powerful asset classes, and really why this is a safe bet and investment if it's something that you're looking to invest in. How he finds these undervalued properties, what some of his favorite markets are that especially are ones kind of under the radar that many investors are overlooking or ignoring, and his thoughts on kind of the current times, where we're headed, what's going on with interest rates, buying opportunities and windows, and where real opportunity lies in today's market and going forward. So if you're trying to figure out how to get off the sidelines into your first deal, or you are looking to, take some of your active W-2 income if you're a full-time, employee somewhere and start to invest in other passive income wealth vehicles, he's got an amazing journey and kind of case study that you can learn from and follow. This one's packed with insight, strategy, and encouragement. I hope you enjoy it. Let's dive into today's episode with Morgan Keim. Morgan Keim, welcome to the show, man.
Hey, thanks for having me, Matt.
So moving from VC into real estate, obviously having some major success, raising capital and, playing in the VC startup tech space to then, transitioning over to the real estate space. I'm very intrigued on, what that journey and I guess what those stepping stones looked like that led you in that direction. But maybe take us back on how did you break into tech startup, raising hundreds of millions of dollars? Where did it all begin?
Yeah, no, absolutely. And honestly, it's such a perfect time to have the conversation too. I feel like right now we're in one of the best buyer's markets that I've seen in 10 plus years. The tourists are kind of out, there's blood in the water, there are deals to be had. And so before I ever became the affordable housing guy, the person that turns around properties nationally, they're really contrarian bets. I was a startup, operator and strategist and fundraiser, helping to bring north of a few $100 million into the food tech space and really kind of pioneering the future of food. And it was very much an intentionality moment for me going into that space after getting my MBA at UCLA, where I decided, I really want to have intentionality with capitalism. I want to be a conscious capitalist. I don't know exactly what that means, but I'm going to figure it out, as I take imperfect action, as I basically look at how I can solve a big problem in the world. And at that time, food sustainability was really high on my radar. And it still is to some degree. And what I found was that in jumping into the space first, head on, we're trying to basically give consumers products that are like, you know, not meat, but it tastes like meat, not, milk or cheese, but tastes like, has the health benefits, that kind of stuff. And we got a lot of, seductive energy around the venture capital community to go start these high flying, high impact ventures. And the reality is, with every 10, with every $100 million raise you'll land, the goalpost has moved so far out of sight. I mean, you might as well be commuting to Tokyo, right? And so at the same time, when I started that career, I did kind of have the foresight to sort of see that. And I also lucked in a little bit to learning about real estate, and particularly in multifamily, sort of affordable workforce housing. In fact, the place I was living in Santa Monica, California, was sold to an investor group. And I remember I'm writing rent checks to one person. Now I'm writing it to somebody else. And I asked about the deal, and I learned that the people who sold it made like $1 million on this threeplex. And I'm like, what? Like, what do you, this is crazy. Like, what? Tell me about the composition of this. Like, where was I in this conversation? I want to learn about this. And I actively ended up pursuing these people and ultimately started to actually passively invest with them in these small multifamily syndications across Los Angeles, quietly doubling money every 2, 3, 4 years as they, basically ran a value add strategy while simultaneously running my active income venture, making, headlines on startup growth, on venture raises, on big B2B partnerships in the food space. And there was a point where I caught myself on my weekly commute from Southern California to Boston. Got to be there for the Monday meetings, which means Sunday flight. I hate the red eye. So it's like a 1 o'clock flight, right? And I remember I was taking off from LA. I think it was like September. Absolutely beautiful day. My wife is at the beach. My friends are all there. And I'm like, what am I doing flying away from everybody I love to chase this external ambition that I don't think anybody will ever totally be happy, even if we IPO, even if we get the exit, then you're a publicly traded company. You've got all the pressure of that, right?
Yeah.
When on the same time I'm looking at my other side of the barbell strategy and going, these things are quietly cash flowing for me. They're quietly exiting. They're quietly being rolled into 1031 exchanges so that I get tax-free gains. And at some point, that side project of investing passively in multifamily real estate became Ocean Ridge Capital, which is what I lead today, essentially turning overlooked housing, workforce housing into durable wealth for founders and executive people that want to get off the hamster wheel, just like I did.
That's beautiful, man. What a journey. Now, you slowly glossed over something that I think is really important because it's always fun to hear how somebody breaks into the space and kind of has the aha moment, but then does something with the aha and takes action on it. Yours
Mhm.
was you were renting a place that got sold to a group that then you decided to kind of peel back the layers of the onion on and start asking questions around why they did it, how they did it, what's their, overall outlook of this. Like maybe unpack that a little bit on you got curious. What did you do next and how did you do that?
Oh, I wish I could say I had like a great, synthesis of the mind and it all clicked together. There was like a breadcrumb, or there was like a thread of a sweater that I started to pull. And the more I'd pull on the thread, the more that sweater would unravel. But what I realized it was the inklings of understanding the difference between income and ownership, right? I was making income, but I didn't have ownership. And God forbid something happens to me. Now I have two daughters and a wife and a family I support. Even more so now, if something happens to me, if we don't have assets that are making money for us in our sleep without me having to constantly be giving my time to them, then, you know, biologically, we're going to be worse off than before, right? And that was like the start of it.
Mm,
But what really clicked for me as I began to kind of pull the thread further was the concept of what leverage can do in that regard, right? Because like assets and ownership are fun to talk about, but it's really the leverage of having assets that creates the effect of freedom, of durable wealth, of passive income, whatever we want to call those things. And so there are like three forms of leverage. Do you know much about this?
I would love for you to explain it to
Okay,
us.
let's talk. So Naval Ravikant says this really well in his book, by the way, in the Almanac of Naval Ravikant. Highly recommend the book. But they talk about the three forms of leverage. The first of which is labor leverage, right? It's like when you go to your parents, you're like, I'm starting a company. Their vision of success is like, you have 400 employees and all this stuff. That's like labor. It's people that are working for you, and that's your leverage. There are great forms of this. However, there are also flaws to it, right? People can walk off the job, key man risk, all these things, right? But a lot of us have built our companies on labor leverage. That's fine. But the further up the chain we can go into the other two forms, which would be capital and permissionless, the more freedom really can be enabled for less input of time and effort. So capital is sort of your next stack of leverage. right? That is going to be money working for you. That's really a lot of like real estate investing is capital leverage, and it really helps to, stack the chips in your favor. Capital can also freeze up at key times in the cycle, or it can get expensive, right? And it's not the perfect solution. And capital leverage can also ruin you if you don't use it right. And we've seen a lot of people, I think, from the syndicator boom in 2020 and 2021 that are sort of feeling the pinch of that
100%.
floating rate short term debt right now. Right. So if you use it wisely, though, and you're really thoughtful with your debt, it can be a really, really good asset, not a liability. And then, final is like what we're doing here. It's permissionless leverage. It's code base. It's AI. It doesn't quit on you. It doesn't decide one day, I'm gonna walk off the job. And so the more we can stack these forms of leverage together in our favor towards solving a problem that we want to solve, the better we can free ourselves from the day-to-day grind, the hamster wheel, all these things that we're, kind of being pulled in different directions on. And so I found a lot of avenues to really create that intentionality with workforce housing, with what we're investing in, and how we communicate to the entrepreneurs and the founders that we're serving using permissionless leverage and things like that.
Now, I want to definitely unpack permissionless leverage. Before we do, talk about you're a smart dude. I know you know how to put together decks and dissect, capital stacks and where the value and arbitrage is at. So what was it about affordable housing, multifamily that kind of won your heart as the asset class of focus versus looking at other ones?
To be honest, the key line here is contrarian, which is so funny because it actually comes at a societal moment where you've seen the headlines 500,000 more sellers than buyers this spring in the real estate market. Yet there are like 5 million missing affordable housing units nationally. So, in a way, that's not really that contrarian because the data is right in front of us. Yet a lot of people don't want to go and do the work. I think they want to chase Miami high rises or, whatever. I don't know. I'm not going to even juxtapose like I know that situation. I just saw an opportunity. And particularly when I was getting serious about taking this into my own hands and not just doing LP sort of passive investing, which I started in 2014, carried all the way, I still do LP deals sometimes. But around like the 2020 mark, I started to build my own fund and raise private capital to go into affordable housing. And we saw the best counter trend opportunity I've probably ever seen in my life, although we're seeing the setups of some really interesting things today too, in that growth capital was chasing new developments and syndications in Austin and Boise and, Boulder. Let's all go where the money's going, right? That was such a thing.
Yeah.
We went into Cleveland, Ohio. That was not where the money was going. And we were able to pick up duplexes, quads, sort of small multifamily type stuff for just pennies on the dollar. Um, at value quotients of like 10 to 20% what it would cost to build a new version of whatever we were buying. Incredible value. And you would think, okay, well, does desirability not come with that? Is that what you're trading off? Well, interesting enough, in the affordable housing space, you always have a perennial supply problem. There's always demand,
Yeah.
either from Section 8 and some of the government programs, or just people who just want to, at or below the median rent of that area. You will always undercut the other groups, and you can win. And you can have, well north of 90% occupancy and do really well with those strategies. So we bought relentlessly in Cleveland. I mean, we did like 20 multifamily deals in 18 months. We were just buying everything we could, off market, on market, and everything penciled in at a point that it just made so much sense relative to what we could get on rent, that we underwrote 0% growth. And we said, we're just going to keep this thing as a cash flow fund. But the reality of what happened is, fast forward 3, 4 years, nobody built in Cleveland and similar markets, Milwaukee, Rochester, wherever, right? But there's still demand. So the assets have appreciated tremendously. Whereas, like, some of the assets in Austin or Boise are struggling or have really seen severe corrections. So the
Hmm.
counter trend thesis was a really kind of core part of that strategy. And we do a lot of that now, and looking in like pre-institutional, smaller tertiary markets for similar types of assets that are a little bit bigger, maybe 50 to 150 units, where you're not going to have a ton of people that can be capitalized from the local market to go buy the thing. And you're not going to be competing with Blackstone in New York that's watching that market either. It's like a sweet spot for us, and we do really well right there.
Yeah, I'm a data guy, so I always like to let the data kind of do the talking and drive, sentiments and decisions. I can just hear from the way you're talking. I think you're a data guy too. So I'm
Absolutely.
curious how you utilize the demographics and the data to help you land on, let's call it Cleveland, Ohio, and maybe what are some of the other markets that you're, looking at in terms of data that you like that align with your kind of tertiary under the institutional radar, appetite that you think have some opportunities in this particular sector.
Sure. So I'll give you a little bit of a nerdy answer and then a higher level answer. The nerdy answer is I really like a couple key metrics, right? You know how Warren Buffett has his metrics, I
Yeah.
really love things like price to rent ratio, basically what somebody would pay, you know, per per year for a unit relative to what you're going to buy it for. I love looking at replacement costs, and then I'll juxtapose all of that over what's happening in those markets. Are we seeing north of 1% a year population growth? Are we seeing new supply keep up with that? Are we seeing, employment demographics? Because I know we love to talk about work from home has displaced everybody and everybody can do everything. But the reality is a lot of the national markets still aren't there like that. There are population job centers for a reason. And even if we continue to have a proportion of those folks going digital, there's still such a basis for having good, strong job markets. So we like to look at, under 4% unemployment, things like that. And we have a whole host of other things we use to categorize. We sort of overlay that onto landlord friendliness, other types of demographic type shifts. I love new family formulation, our young families basically coming up and kind of looking at things like that. And they really enhance the long-term profile of where that that market or that population center could go. Now, it doesn't need to be explosive either, right? It just
Right.
needs to be steady. I like steady. What's that saying? It's like a Navy SEAL. It's like slow is steady and steady is fast. If we get that and we go and buy something that's just kind of overlooked and it needs, a decent amount of value add, we need to make it, clean, safe, affordable, attractive. And we can do that in a relatively constrained budget and we do that in a market that's steadily growing, chances are, I mean, you've insulated so much of the downside protection that the upside will gradually take care of itself. And those are the kind of singles, doubles, and triples I'm looking for, not home run, boomtown kind of deals.
Yeah. And, for those that are going, okay, well, let me stay away from the boom towns. What are the markets that Morgan likes that maybe I should be paying attention to and why?
Well, it's funny, right? I'm gonna overlay some lifestyle goals on top of this
Okay.
because the markets that I like are gonna be different than what are all the best national markets, right?
Right.
But I like to follow the national story. However, at this point, I really look only west of the Mississippi because
Okay.
I don't want to spend more than 4 or 5 hours on a plane trying to get to see a property at any given time, right? Now, if you look nationally, I mean, I see a lot of potential in like Greenville, Spartanburg, South Carolina, Columbus, Ohio, Indianapolis, these near shoring spots where whether or not you care about what's happening on the policy level, you're just seeing internal developments from companies that are bringing jobs to the region, and the housing needs to keep up with that. And again, this is workforce housing, right? You're
Mhm.
going to follow the workforce.
Yep.
I love little pockets in Middle Tennessee. Nashville is an interesting one because it's a little bit overbuilt, but there are areas around it like Clarksville, Tennessee. I just salivate when I see a deal in Clarksville, growing at north of 2% a year. There's almost no multifamily. You're immediately finding people that want to live in your units. And those are the kind of places we look. Now we're also investing particularly in, I would say the sort of pockets in the Southwest that are a little bit overlooked. I think the Oklahoma markets are just completely slept on. Oklahoma City,
I love
which is
Oklahoma.
seeing, I mean, what, billions of dollars of development into that city. Same with Tulsa. We have a pretty sizable position in Lubbock in West Texas, which is where Texas Tech is. And we were able to actually acquire just an unbelievable property a half a mile north from a $242 million stadium development, Jones Stadium, where they just have all the Red Raiders games now. And, people are just not looking at these markets the way they're looking at Dallas and Phoenix and Denver. And so we can go in as, almost like I'd call it a micro private equity strategy and find really, really good return targets for our investors with really good cash flow stories, just kind of buying things that people are not, aggressively bidding up.
Yeah.
And so
Where
that's the sweet spot.
where are you finding your opportunities? How are you guys, kind of continuing to keep the pipeline of deal flow, consistent? And what lens are you guys looking through to identify like, oop, this is one that we like, this is in our buy box versus the ones that you guys are kind of taking a quick look and pass on?
Yeah, I mean, a lot of our deal flow is coming from relationships right now, and those relationships get strengthened with social proof and credibility, right? Um, Case in point, like this property in Lubbock, we bought it at sub 60% occupancy. Um, we have subsequently renovated north of half the property in 6 months. It looks amazing. It's renting up above for a lot of units above our 2-year pro forma. And we're expecting north of 80% occupancy this week. In a matter of a couple weeks, we went from 60 to 80. And like people have heard this. I mean, this is like a breaking story. I haven't even shared this anywhere. And so we're now getting calls from brokers where I guess this data has hit their spreadsheets. Getting calls from other folks saying, "Hey, I just watched what you did there. You're clearly a credible operator. We have a property I think that would fit your buy box really well." So for a while, it was pushing out there and meeting brokers and contacting. Even we were even contacting banks at one point to try to find, semi pre foreclosure type properties. Now they're contacting us. And what's been really unique is we've seen the same exact thing happen in our Cleveland position with the renters. We have government offices contacting us every week to place people in our units because they know that we're one of the most credible operators in that market. So it's like this sort of flywheel effect of you're pushing the rock up the mountain at some point you get up to that top and it starts to roll downward. And we're in a place where it's actually all kind of streaming in now. And we're just taking it, filtering it, looking at affordability, heavily price conscious to your question on the filters. Because frankly, protect the downside. You can't fix a bad buy,
Yeah.
but you can fix other things, right? So we're really aware of that. And then just making sure we're in fertile soil, good markets, strong debt that can last, right? Be able to cover the debt and having a good idea of who's going to buy it at the end. A lot of people overlook this, right? The exit strategy. They say, I'm just going to buy this thing. And we're going to figure it out. The reality is, you should probably know who's going to buy this thing from you 3 to 5 years out and then start to backtrack what they want and
Mhm.
deliver on that product. Because at the end of the day, you're not just a conduit for affordable housing of tenants, not just a conduit for creating enduring wealth for investors, but you're also a conduit for your future buyer in creating a product that they want. And so you really have to serve all those different needs.
That's such a good point that I think a lot, like you said, a lot of people overlook that, right? Just like I'm assuming in the venture capital space, you need to know who your end buyer is if it's going to be private versus if you're going to IPO. There might be a different strategy, a different team, a different
Yeah,
org chart, different overall execution in order to meet one of those paths, right? And that might look a little bit different. Same thing on real estate assets, understanding if it's going to be an institutional level buyer and what they want to see in the deal versus,
sure.
maybe a regional, family office or mom and pop, high net worth individual. Those are all things that, like you said, are really important to take into account in terms of strategy and execution. What do you say to the new investor that maybe doesn't have the relationships built yet, that doesn't have a lot of the capital, solidified. I always get that question of like, how do I get that first one under my belt?
Mhm.
What do you say to that person?
I think be a part of the solution, right? I mean, typically, if you're looking at these deals, maybe you have two main avenues. There's like the deal sourcing and management, and then there's like the capital, right? And that could be equity and that could be debt. I think now more than ever, there are ways to play as a niche specialist as you learn the business, right? I am fortunate enough to have started passively investing with a group that knew what they were doing. They're very credible sponsors. I did, I think, 12 deals with them before I ever did anything active myself. And I literally I would scrap together whatever money I had. Even if I didn't have enough, I'd go to a couple friends and say, guys, I can't afford the minimum of the syndication check, but I love this deal. And here's why. And here's what I learned. And here are the questions. And I'd raise the capital to afford the minimum just to get me access to learn the deal.
Mm,
That's a pretty low barrier at that point,
mhm.
right? You find your way in. You find your way in. And through that, I learned personally, well, I like the capital side. Let me focus a little more there. Let me also learn some of the operations. And at some point, you can build a robust skill set. Conversely, on the deal side, there are so many ways to get involved here, from hunting deals, from outreach to brokers, and developing relationships with people that have done this before. You can create value in any regard. If you brought a deal, if you brought capital, any of those things. And even if you're so new, but you're making good income and you're just trying to figure out, how do I get a little skin in the game here and start to learn this? Meet a handful of sponsors. I'm happy to talk about this, with you. Matt will talk about this with you guys, and we'll all talk about, well, what's right for your strategy. Let's try to see around some corners, try to find a way to write that first check, even at a minimum level, because you're going to be so invested in learning all aspects of that deal. It's not really about that deal. It's about the deal you do like 10 deals from now that's going to make you so much money because you learned it on the first one, right?
Yeah,
And that's what you should be investing in.
such a great point. I think a lot of people desire and expect to hit a double, a triple, a home run on their first
Yeah,
deal. I always tell people if you break even, you won on the deal because you already
absolutely.
learned a ton. You got new relationships, new confidence. You
Mhm.
understand kind of a full cycle on a deal. If you made money, you really won, even if it's, $100, right? Um, and if you get lucky and you do great, you're gonna do extremely well. But most importantly, it's about the stepping stone of getting you in the space, building some of that confidence, understanding the mechanics of a deal cycle, and then, right, you really have a lot more latitude to, play with as you move forward in deals. For those that are un I want people to understand kind of the difference between why you decided to go fund versus syndication, right? A lot of people go deal by deal, syndicate, deal by deal, versus some people go, I'm clear on what I want. Here's my investment thesis. We're going after executing on this business model. We want to, more of an evergreen fund that gives us some of that flexibility. And maybe it's not evergreen, maybe it's closed fund. But why did you decide to go fund versus syndication?
Yeah. Well, so for the fund vehicle, because I actually do both. We'll do some syndications, but for our fund in particular, that was focused in Cleveland, Ohio. The reason we did that is because we wanted to buy properties in cash quickly and get unbelievable deals, which is exactly what we did. And it worked really well to raise a bunch of money up front and then go deploy, deploy, deploy. In other regards, we'll look at doing syndications for one-off type of properties that are larger, and we'll raise on those kind of things. We'll also target, by the way, I mentioned about having the parameters of I'm really only investing when we're operating on this side of the Mississippi. But if I see deals on the other side and markets that I like, and I know the operator, I mean, we've done 100 deals at this point, LP and GP. I'll underwrite the full thing and we'll create access for investors to back other sponsors' deals. We'll actually create little mini funds and we'll go and say, hey, rather than write you, let's say a 50, 100, 250K check, we're going to write you $1 million check, a $2 million check. But for that, we want institutional terms rather than maybe a 70-30 profit split. We want an 85-15. and we'll pass on some of the savings to our investors so that they would really get like an institutional quality offering in a deal that's managed by a professional sponsor where we've done the diligence, we've vetted the asset, the sponsor, the strategy, and then create that access and basically pass on the benefit to them.
I love that. Now, what does your team look like? How big or small is your team? I think a lot of people think, when they hear fund, right? Like, oh, he must have 50 people working for him and, you know, all of these assets under management. Just, kind of break down the different context to what funds and fund structures and teams can look like.
Sure. My team is unique. Everybody has a really strong either operating or sort of private equity diligence background, and it's an interesting pairing because on the one hand you get sort of an institutional grade pedigree, on the other hand you get scrap and perfect action, get it done. There's no such thing as no, right? And it's a really fun sort of thing to have in one wheelhouse. So, for instance, our primary operator he just learned this business from the ground up. Entrepreneur 101. I mean, just the type of person that anything that's wrong, it's going to get solved intra week. He's going to find a way, right? But then we balance that out with we have another person out of institutional private equity who just he knows how to structure diligence. He knows how to deliver at a caliber that's that very few people do, right? And there's another person on my team, our underwriter. We took a chance on him. 23-year-old African immigrant. His name's Yannick Ngongo. Came over from the Congo and has basically just thrown himself into the real estate community, hungriest person alive to learn the underwriting business, to learn stabilization, to learn lease up. Yannick is like our powerhouse where we figured out how to throw him into special situations like getting occupancy in a property. And he'll be on the phone for 12 hours and he'll report back the next day and say, we have 15 new incoming people. Just amazingly ambitious, amazingly adaptable, scrappy people that also get that what we're doing is, there's risk, there's professional, you have to kind of keep that balance too.
Yeah.
Um, but there are lots of ways to create your team dynamic. I like when you have the entrepreneurs under the roof.
Totally. Yeah, those entrepreneurs are the best people to have on your team for sure, right? Because they have a little bit of
Absolutely.
that rogue mentality of like, I'll do whatever I got to do to get this thing done at any means necessary. But obviously, they play well within team environments, and given the guardrails and the tools, they go and succeed better than maybe sometimes having to do all that by themselves.
Absolutely.
When you talked about driving value, driving income, driving occupancy, what are some of the mistakes you see people making on the assets that you guys are buying, and how do you guys arbitrage that opportunity, and what do you do so well that allows you to drive income, drive occupancy that you see others missing?
Yeah, it's a really good question. What we've seen in the properties that we buy is usually whoever sold it to us was not capitalized to do the renovation. And
Yes.
that's a big mistake, unfortunately, that a lot of mom and pop sellers make. But typically, we kind of are rescuing them out of a situation they really shouldn't have been in the first place, where maybe something needs $10,000, $15,000 a unit to rehab it, and they're trying to fund it out of a salary or something, and they can do one or two at a time. You're never going to get occupancy that way. It's just kind of have to hit it and go. So we see that a lot. I've seen some situations where people have overspent or they've had maybe not the best diligence on the contractors, things like that. I think we strike a really good standard of what we deliver to the market. And it's kind of what I would liken to a Ford Focus in Mexico or in Vietnam or any international traveler who's ever like rented a car. It's the same thing you're gonna get in Naperville, Illinois. But there's that little console that would have the GPS in it, but it's not there. It's just kind of plastic over, right? Oh, there's like the heated seat, but like there's not really a button on the Mexico version, right? It's the same kind of product, but it's just a little more simple. It's a little, but it's safe. It's affordable. It's going to get you where you want to go. It's going to feel like new. you're going to be proud to own it. And frankly, for a lot of the people, especially that we serve in the more affordable and workforce housing domains, they're not used to having stuff that's new and nice. And we deliver that. And because of that, we win in the space.
Mm, I love that. Yeah, I mean, finding out where those, market gaps are at and filling them. And to your point, which I think is a critical thing that I see so many people get themselves into a bind financially over, which really hinders the overall performance of the deal, the asset, the returns that you can offer yourself or your investors, is not giving yourself a proper amount of reserves to execute on your
Absolutely.
game plan, right? Like one of the worst things
Absolutely.
you can do, just metaphorically in terms of a house, right? If you're building a house and you build the house, but you didn't budget enough to, put the fixtures and, finish the house out, then the value of that house is,
Yeah.
intrinsically missing a significant portion there because you just came up a little bit short. So, like, that's the worst thing you can do is underestimating your CapEx or the timeline that is necessary to get it there and selling yourself short because oftentimes it's that last 5-10% that is all the icing on the cake that you're going after, right? And so you
Mhm.
really want to make sure that you don't shoot yourself in the foot there.
Absolutely. Let me ask that same question to you too, because you deal in some different asset classes, right? You've got hotels, done a lot of single family flips. Like when you're looking at deals now, what do you see as the trends of like this is going to be a good buy? This is the type of composition you're used to seeing in your asset classes.
Yeah, I mean, oftentimes it's a lot of just mismanagement, right? I mean, when you think about the overall diligence that makes those that are killing it versus those that aren't, it's the discipline around just the little details of how you manage and operate an asset. I always tell people one of the hardest things to do, it's not finding the leads. It's not, modeling a pro forma. It is once you close on that deal, it is when the real work starts,
Oh yeah.
especially because I'm a value add guy. So if you're a value add, you're not buying some stabilized asset, right? I mean, you really have a lot of work that needs to go into this thing in order to capture all of that juicy, profit that you see in the pro forma. And so there's a big gap that I see between, sponsors that are maybe just good at modeling and maybe, doing the stuff behind a desk. But when it comes to managing a team and executing on a physical business model and an asset that requires you to do all of those things right to bring those numbers on the pro forma to life, that's where I see a big disconnect between a lot of people. And so that's where obviously, having a great team around you is you don't need to be the
Yeah.
person that is the expert at all of those things. To your point, right? You've got a great underwriter, you've got a great capital stack guy, you've got a great operator, things like that. So that's where, the power of a team I think is really, really important is just making sure that whatever the asset requires, because every asset is different, every, let's call it business model or product type has its own nuances, but a lot of the mechanics are the same. And the ones that I see crushing it time and time again are, yeah, they've got the underwriting and the lead gen figured out, but oftentimes it's the ones who are just insanely dialed and disciplined operators that are the ones who weather the storms and oftentimes capture all the juicy upside that most people fall short on.
I absolutely agree. And it's such a timely message too, given the buying window we have,
It
right? I
is,
mean,
you're
we
right.
just saw the excess of money 4 or 5 years ago that's leading to people that were financial modelers that had no idea how to actually stabilize a property.
100%.
And those are going on fire sale
Yep,
today, right now.
yep,
So like for people listening that are thinking about investing in the space, maybe that haven't done it before, this is one of those times when it's hardest to get deals done. Rates are high and it's challenging. It's a challenging capital environment. Yet this is where the money is going to be made 3, 5 years from now. This is where people look back 3, 5 years and say, "Oh, you were a genius to be here now. Oh, who if I only saw, I would have been buying everything." We're in that inflection point right now. And in the side that I know best, which is multifamily, we're already well past the supply cliff nationally of building new properties and building new multifamily and bringing them online. We're at a point where demand is about to eclipse new supply, which is going to create a crunch on rents which is going to create an elevation of the prices of any asset that's out there today. And by the way, 2 years from now, there are going to be very few new multifamily properties out there because it's so expensive today to build them with where construction rates are. So in the next 2, 3, 4 years, we're at this really unique place in a lot of cities where rent demand is more than likely going to skyrocket again because there's not going to be enough supply for the people that need to live there, especially in places where it's growing and where the supply is not keeping up. It's a really, really good time to look at some imperfect action and to stack your bets and get a little bit of it, out of your company, out of your active income, and into the space, however you want to play it. If it's in the hotel space, if it's in multifamily, if it's in something else, there are a lot of opportunities shaping up right now.
Yeah, I mean, you kind of beat me to my last question, which was kind of, what are you seeing and feeling, to kind of close out the end of the year? Obviously, there's a lot of pressure to cut rates. There's a lot of concerns on the Fed side of, tariffs and inflation still being TBD and how that ties into the overall, Fed thesis on how they close out the year heading into 2026 with rates. What is your overall sentiment and feeling on, some of the headwinds that are out there? Obviously, in every bear, sentiment, there's always bull opportunities somewhere.
Mhm.
So how are you navigating that? What are you, seeing out there in the near and maybe more of the long-term future beyond what you just shared with us?
Yeah, I mean, look, we're on a roller coaster of headlines right now, and my crystal ball is super fuzzy, right? I don't even try. But on the same point, fundamentals exist. We're in a really fundamental environment where people need places to live, and if more people are showing up in markets that don't have enough of those places, basic laws of supply and demand will increase rents, increase values, that sort of thing. That fundamentally moves the value of real estate up. And even if rates stay the same for a couple of years, let's say that's worst case scenario. Maybe there's more distress. There are more buying opportunities. There are more banks that say, we're not willing to extend this loan anymore. You're going to give us the property. But banks are not in the game of managing property. They're in the game of making loans.
Yeah.
So they're trying to just get those things off their balance sheet. More buying opportunity for guys like us and people that want to find high yield, high performing investments with competent operators who know what they're doing, right? So I think it's much more opportunistic now than even a year or two ago.
Hmm.
I kind of thought we might have a long hold on these interest rates, and we've been cautious on our buying. Unless there's like a really creative situation where we could like absorb a loan that's 2 or 3%. We did a fair bit of that for sure. Um, but right now, it's just the fundamentals of supply and demand nationally in a lot of markets looks really good, regardless of whatever today's headline is.
Yeah.
Over time, if you can weather the storm that we're in today, there's a really high likelihood, I think, that you could do really, really well in these investments.
What are your thoughts around, final question, interest rates? I've been seeing, you know, a lot of, at least let's just call it in the futures market, right? We started the year, I think, with 3 or 4 cuts. Now we're at least down to two, which it's looking like that first one may come in September. Um, we've got Trump calling for, 300 basis points, drop, which I don't see that happening, even though as a real estate investor, I would freaking love that. I don't
Absolutely.
think that'd be great for the economy as a whole. I've been hearing and seeing more whispers from relatively reputable economists saying that they actually think interest rates are going to go up in the next 12 months. What are your thoughts and why?
It's a really good question. And I think a lot of it is just going to hinge on what happens in inflation, what happens with jobs, right? It's the two mandates that the Fed controls. And
Hmm.
the Fed influences interest rates. They set a standard, but we've also seen, mortgage rates detach a little bit from that based around investor demand, right? And that's not like just investors like you and me. That's like big pension funds and entire countries that are investing in things like treasuries, right? And that are actually really setting the price that we pay on our interest rates, right? So I kind of think it's like twofold. Do we see jobs hold steady? Do we see them start to decline? Does AI disrupt that considerably? If we see just a disruption in jobs, we're more likely to see interest rates fall, because that's going to mean that liquidity needs to be back in the system a little bit to hire more workers to help increase the jobs. Now, on the other side, they printed a heck of a lot of money.
Yeah, they did.
And we're probably still going to have to pay the price for that for years to come. At the extent of that, I don't know, right? I don't know the reach of just what that does in the next several years, but I do know hard assets tend to hedge really well against it. And that's why for me, like when 2020 and 2021 was happening, I felt a mandate of getting as much money out of cash and putting it into something hard and durable that was just going to track whatever was happening there, so that at least I didn't have to, wonder, am I going to get 6, 7% of my money evaporated annually? That's like a death sentence,
Yeah.
right?
Yeah.
Not what I'm trying to put my family through. Longer term, I think things do support lowering of interest rates. I don't think we're shooting down or anything like that. I think
Yeah.
it's going to be a slow climb or slow sort of descent. Um, but I'll welcome it if it happens any faster.
Yeah, you and I both. I mean, it is an interesting, right? I think there's reasonable arguments for both sides of it.
Yeah.
The people I hear talking about rates potentially, staying higher for longer or even going up over the next, couple years is, this administration is very pro growth, and they're, bringing in a lot of foreign investments, trillions of dollars to bring them into the United States. Obviously, the tariff trade talk and kind of recalibrating a lot of those relationships, reshoring a lot of
Mhm.
manufacturing back within the US, the golden age that Trump keeps talking about, whether you like him or not. I think there's a lot of
Yep.
policy that is already in motion and likely going to continue to come into play over the next, few years of his remaining term in this administration that
Yeah.
could keep the drop market, relatively strong, right? Which could prevent some of that. But I do think there's, probably more of a stronger argument for reducing rates and easing, a lot of the pressures that we're seeing some of these higher rates, push into certain industries, specifically, obviously, in commercial real estate. So appreciated your time, your perspective, and loved hearing about your journey and what you guys are up to. And obviously, we've got a lot of people that love investing passively in other
Mhm.
deals, love looking at, what different sponsors have to offer. So if anybody's interested in multifamily affordable housing, they want to check out your group and what you guys are doing over there, what's the best place for them to do that, Morgan?
So jump over to Ocean Ridge Cap, that's CAP.com. We are just releasing a new ebook. It's called The Passive Wealth Playbook, an entrepreneur's guide to building enduring wealth. Highly recommended. It dials in a lot of what I've learned doing 100 deals in the last 10 years, basically to a framework that y'all can follow. Look, if we can be of resource to you and help you guide into strategy of like where real estate fits in, or just looking at creating more passive opportunities, I'm happy to offer that to anybody listening.
We'll be sure to link up all of that in the show notes. Check out the website, all of the information to connect with Morgan and his amazing team. Thank you for coming on the show today, brother.
Thank you, Matt, for inviting me.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys, getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.